Hello, I'm Tammy, and this is your week in Forex from MaxiForex. Today we will take a look at last week's market highlights. It was another volatile week across most major markets. The greenback finished the week considerably lower, with the consensus amongst most traders that there will be no rate hike in the US for 2010. Now let's take a closer look at the markets with foreign exchange analyst Martin Smith. Hi Martin, nice to see you again.
Hi Tammy.
Last week, the equity markets started off with far better than expected data releases as far as manufacturing data, as well as import and export figures coming out of China.
Yeah, correct. The market surged on the positive economic news. In the ASA session Sunday night, following the data release, equities rallied hard, and that carried through the European and US sessions as well. Now, if China, of course, who's seen as leading the global recovery, is showing tremendous growth, then it follows the rest of the world should not be too far behind.
It was rather shocking that just a day later, the People's Bank of China, or PBOC, decided to raise the rates on the one-year bill. What was your take on this?
Well, analysts have been talking about a move like this for some time. However, the proximity to the positive economic data released in China led to the early week volatility. I mean, of course, the Chinese are concerned about creating asset bubbles in their own economy, and real estate prices are doubling in some areas. Now, with money flowing easily, artificial growth becomes a high priority. And given the economic crisis that the global economies are just beginning to emerge from, well, of course, this is even more important.
What did the PBOC actually accomplish by raising the reserve requirements?
This was a direct monetary tightening policy, and it caught the market off guard as the Nikkei plunged more than 1.5%. Basically, the PBOC is attempting to drain liquidity from the market by raising the reserve requirement.
That makes sense. We also saw on Thursday that Australian unemployment, it printed far better than expected. What do you think these figures are saying about the market?
Well, Aussie unemployment came in at 5.5% versus the previous 5.8%. Well, this is obviously good news as it continues to confirm the recovery is underway. Employment figures in Australia were also positive, beating analyst expectations by adding 35.2 thousand new jobs in December.
With all of the positive economic news, why is the euro trading the range versus the greenback?
Well, there are a number of factors here. First of all, sovereign default risk is at the forefront. Greece's economy, for example, is faltering, and rumours have surfaced about Portugal as well. Now, once you start thinking along these lines, you have to ask yourself, well, what other countries in the Euro bloc could potentially be in financial distress? That's one. Secondly, the ECB held interest rates on hold, and ECB President Jean-Claude Trichet implied that rates may be on hold throughout 2010. Now, in some regards, there's not a lot that separates the dollar from the euro.
Since it appears that the implied correlation between the US stock market performance and the USD is again returning to pre-November status, do you think the greenback is in trouble once again?
Well, risk has returned to the marketplace to start 2010. I saw an interesting figure from the JP Morgan Emerging Markets Bond Index Plus, which indicates that the spread to hold treasuries versus bonds in developing countries narrowed to something like 2.67%, nearing a low not seen in over a year and a half. Now, with the Kiwi and Aussie dollar soaring versus the US dollar, risk-taking is definitely back in the market. Now, this means that low-yielding dollar will mean a weak dollar, and this may be a theme in the market for some time to come.
What do you think that our traders can anticipate for the week to come?
Well, our forecasts call for the euro to advance against the dollar. Now, if the euro breaks the 100-day moving average, currently up around 146.70, we then expect it will climb to 148 handle. Otherwise, it will bounce between support and resistance. I expect the yen will reverse some of its gains. And lastly, if the Swiss franc breaks dollar parity, I think the Canadian dollar will move within striking distance as well. I mean, there are a number of CAD economic releases slated for this week, and we have already seen the BOC speaking harshly about letting their currency overappreciate. So this may be a volatile week for the Canadian dollar.
Well, thank you, Martin, for joining us once again. Until next week, my name is Tammy, and be sure to visit us at maxiforex.ru.